Investing mistakes to avoid. Investing is a journey filled with opportunities to grow wealth, but it's also riddled with avoidable pitfalls. As experienced investors, it's crucial to refine strategies by identifying and steering clear of common mistakes. Avoiding these errors can be just as important as making the right moves. In this video, we'll provide valuable insights into frequent investing errors and actionable strategies to prevent them. By the end, you'll be equipped with the tools to secure long-term success and build a more resilient portfolio. One of the most pervasive mistakes in investing is making decisions based on emotions rather than rational analysis. Even seasoned investors are not immune to the psychological challenges posed by market volatility. When markets experience dramatic downturns, fear often triggers panic selling, causing investors to lock in losses instead of riding out the storm. Conversely, during market booms, greed can lead people to overinvest, chasing returns without adequately considering the risks. Emotional investing often results in poorly timed decisions that negatively affect portfolios in the long run. Behavioral biases such as anchoring, clinging to initial information, or herd mentality, following the crowd, exacerbate emotional decision-making. These impulses can cloud judgment, leading investors to stray from their well-thought-out strategies. The solution lies in cultivating emotional discipline. Develop a well-defined investment plan and stick to it, regardless of short-term market fluctuations. Recognize that volatility is a fundamental aspect of investing, and you'll be better equipped to make clear-headed decisions. Another common mistake is an over-concentrated portfolio. Putting all your resources into a single stock, industry, or asset class may seem tempting, especially if it appears to be performing well. However, this approach exposes your portfolio to significant risks. Consider this scenario. A portfolio heavily invested in tech stocks during the dot-com bubble experienced massive losses when the bubble burst. While one or two sectors might deliver exceptional gains in the short term, their downturn could severely damage an undiversified portfolio. Diversification is a foundational principle that experienced investors must prioritize to mitigate risks. Spreading your investments across multiple industries, regions, and asset classes ensures that a poor-performing segment doesn't sink your entire portfolio. Use tools like index funds, exchange-traded funds, ETFs, or mutual funds to achieve broad exposure and safeguard your wealth. A truly diversified portfolio considers correlations between assets, the degree to which their values move together. Aim for a mix of assets that respond differently to market shifts, such as combining equities, fixed income, and commodities. Experienced investors often fall victim to short-term thinking, a behavior influenced by the lure of lucrative trends or quick profit opportunities. Chasing the latest stock fad or reacting to daily market news can lead to overtrading, unnecessary risks, and diminished long-term returns. For example, many investors during the cryptocurrency boom of 2017 bought at the peak due to FOMO, fear of missing out, only to suffer massive losses when the market corrected. Similarly, those who attempt to day trade frequently neglect the transaction costs and emotional toll associated with rapid buying and selling. The antidote to short-term thinking is a disciplined, goal-oriented approach. Focus on your long-term financial objectives, whether it's retirement, funding education, or creating generational wealth. Stick to a strategy that is designed to meet those goals over decades, not days. Avoid reacting to market volatility or sensationalist headlines, and revisit your broader investment plan regularly. Remember, time in the market often beats timing the market. Allow your investments to grow steadily over time instead of seeking instant gratification. Even experienced investors sometimes overlook the silent wealth drain caused by investment costs, such as fees and expenses. These include management fees for mutual funds, advisory fees for financial planners, trading commissions, and expense ratios of ETFs or index funds. While these costs may seem small in the short term, they can significantly undermine the power of compounding over the years. For instance, a portfolio with a high annual fee might experience much lower growth over 30 years compared to a low-cost alternative. To prevent costs from eating into your hard-earned gains, prioritize low-cost investment vehicles. Index funds and ETFs often have much lower expense ratios compared to actively managed funds. Take the time to read the fine print on any investment product and compare fees before committing your capital. Adopting a cost-conscious strategy enables you to retain more of your returns, allowing compounding to work its magic over time. Albert Einstein famously called compound interest the eighth wonder of the world. Yet many investors underestimate just how transformative compounding can be for their wealth. The principle of compounding allows your returns to generate even more returns over time. For example, $10,000 invested at an annual return of 7% will grow to nearly $40,000 in 20 years, with no additional contributions. However, a common mistake investors make is withdrawing or using their investment gains too early, effectively cutting short the compounding process. Another overlooked opportunity is dividend reinvestment. Many companies pay dividends, but instead of collecting these payouts as cash, reinvesting them back into the stock allows the dividends themselves to grow, further enhancing the compounding effect. To maximize compounding, adopt a patient mindset and resist the temptation to withdraw from your portfolio prematurely. Staying consistent over the long term is one of the most powerful ways to achieve financial success. Seasoned investors often seek insights from market analysts or financial media. While these sources of information can be valuable, placing too much trust in market predictions is a critical error. Historical data shows that even the most credible analysts often fail to accurately predict short-term market movements. Attempting to time the market based on such forecasts can lead to missed opportunities or unnecessary losses. Consider the unpredictability of major events such as economic crises, political upheavals, or global pandemics. These events can render even the most carefully calculated projections irrelevant. Instead of relying on predictions, focus on principles like dollar-cost averaging and systematic investing. Dollar-cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This strategy minimizes the impact of market volatility and ensures consistent contributions to your portfolio. Remember, consistency and fundamentals, rather than speculative forecasts, form the backbone of successful investing. Many investors neglect one of the most important aspects of portfolio management: regular maintenance. An unchecked portfolio can drift away from the original allocation, exposing you to unintended risks or diminishing returns. For example, if one asset class significantly outperforms the others, say tech stocks in a bull market, it may grow to occupy a much larger portion of your portfolio than intended. This imbalance increases your vulnerability to sector-specific risks. To avoid this mistake, conduct regular portfolio reviews, at least once a year. During these reviews, assess whether your current asset allocation aligns with your risk tolerance and financial goals. Rebalancing, which involves selling portions of overperforming assets and reinvesting in underperforming ones, is a crucial step to maintain a diversified portfolio. Additionally, life events such as a change in income, retirement, or market shifts may require adjustments to your strategy. Staying proactive with portfolio reviews ensures ongoing alignment with your investment objectives. Understanding your risk tolerance is fundamental to long-term investing success. A common mistake is either overestimating or underestimating the risks you're willing to shoulder. Investors who take on too much risk often face heightened stress during volatile market phases, leading to impulsive decisions like selling off assets at the worst possible time. On the other hand, being overly conservative can limit growth, particularly for long-term investors who have ample time to weather volatility. Assessing your risk tolerance involves evaluating your financial goals, investment horizon, and psychological comfort with uncertainty. For example, a younger investor might prioritize aggressive strategies with higher returns, while someone nearing retirement may prefer safer income-generating options like bonds. Align your portfolio's risk level with your unique circumstances. A mismatch between risk appetite and portfolio composition can undermine your strategy and overall peace of mind. Investing success isn't just about finding winning assets. It's just as much about avoiding mistakes that can derail your progress. As an experienced investor, steering clear of emotional decisions, diversifying your portfolio, and thinking long-term are critical steps in building and preserving your wealth. Be aware of costs and how they eat into your returns over time. Recognize the power of compounding and give it the time it needs to work in your favor. Avoid over-reliance on predictions, and instead, focus on timeless strategies like dollar-cost averaging and consistent investments. Maintain your portfolio diligently, ensuring it aligns with your goals and risk tolerance. Ultimately, the journey to successful investing is about mindful planning, discipline, and adaptability. By avoiding these common mistakes, you'll pave the way for a better financial future. Remember, every decision you make today impacts your wealth tomorrow, so invest wisely.